I just read one of the best investing books I've read in a long time, and it's about safe haven investing. Basically, so many people I know, when they invest in the stock market, they think they're doing things that make their portfolio safer, but in many ways, it's actually just costing them an adequate return. As an example, you'll see a lot of people saying, "Well, I'm diversifying away from the S&P because I'm adding bonds to my portfolio." And what happens when you add bonds to your portfolio is that in a bull market, the the bonds will not go up that much. It's compared to stocks, and as we saw in 2022, in a terrible bear market when interest rates were super low, bonds didn't really go up. In fact, they did some of the had some of the worst performances. Had the worst performance in perhaps 100 years, perhaps even more than that. So bonds are not a safe harbor like some people think. And in fact, bonds are kind of a noisy instrument. It really doesn't protect you from crashes. This book, Safe Harbor, really is talking about how to protect your portfolio in crashes, and that's really, really important because if your portfolio goes down, 25, 30%, or even more, it's harder to actually make the money back. It's a simple fact that the way the math works is that as you get bigger losses, the way to recovery is quite tough. So what some people do is they think simple diversification is an easy way to fix this problem, but it really isn't as easy as people think. Another so-called safe harbor that people think of is gold. They think adding like 25% of their portfolio in gold will help to weather the storms. But what we found in recent years is that gold did not go up as much as the S&P, and during the downtrend, there's been some movements up, but really the only time that gold has done really, really well was in the 1970s. And so some people think, oh, gold goes up during times of high inflation, but according to the book Safe Harbor, it's possible that gold only went up so much in the 70s, mainly because the real perceived interest rate was pretty low at the time, and so a non-interest bearing a non-interest bearing account item like gold was able to go up. So it has to do more possibly with the perceived real interest rates rather than inflation. So this means that it's a little bit of a complicated arrangement. Does gold really protect you? It doesn't have that clear-cut connection with the S&P in terms of the S&P going down massively and gold going to the moon. It just doesn't work out that way. And in recent times, we've seen a lot of people, they think, oh, but the answer to everything is Bitcoin. Bitcoin solves everything. And I'm not really pro or anti Bitcoin, but what I can say is that I would say that Bitcoin is not a safe harbor in the sense that it doesn't really protect portfolios like people thought. People thought, oh, if there's high inflation in Bitcoin, we'll just shoot to the moon. Well, actually, it just did the reverse. During times where there was extremely high inflation, the Federal Reserve then raised interest rates pretty dramatically, which caused Bitcoin to go down, and it's hovering around it's been hovering anywhere from 15,000 to 30,000 during this downtrend, and it's not. We won't know it's over till it's over. But one thing that is clear, though, is that if the S&P goes down, in many cases, what we've seen is Bitcoin will actually go down even more. So it's actually a more volatile instrument. So if you're trying to diversify or you're trying to protect your portfolio in order to reduce risk, Bitcoin really isn't a way to reduce risk. Another thing people sometimes do is they'll buy like a value, stocks or ETFs, and they think that this is a way of diversifying from the S&P and maybe get less volatility, lower risk. But I think it's similar to the bond problem in that you might have environments where it actually goes up less than just the S&P, and during the downtrend it may still go down. Maybe it goes down a little bit less than the S&P, and so you're not getting a significant advantage. But this book, Safe Harbor, actually provides the ultimate solution to how to deal with stock market crashes, and it's brilliant because a lot of people on the internet, we love to see videos where people are saying, "Hey, there's a stock market crash," and you should just be in all cash. And I'll admit, I am in all cash at the moment. I'm not going to be in forever, but once the decision is made to be in the market, how do you actually protect yourself from a crash that comes, and actually to in fact benefit from the crash uh, at the same time. So that's kind of an interesting development. In this book, it basically recommends putting about 2% of your portfolio into like put options, perhaps the S&P, and to buy it way out of the money puts. See, way out of the money puts tend to be pretty cheap because it's perceived that it just won't happen. It's not likely to happen, so people underprice it, and as a result, if these strike prices do reach, it will go up thousands of percent. And that could actually really that what that means is that your portfolio, if it actually does this, and I haven't done it myself, but there have been incredible hedge funds like Universa, the hedge fund creator wrote this book. He basically is suggesting, well, your stock portfolio won't go down as much. So if it actually even goes up during these time periods pretty dramatically, just from that 2% allocation, it basically means you're not spending that time, the many years of recovering. And so I think that is what allows for compounding to happen at a much faster pace. If you're not having any losses, well, you're moving up. And it's kind of interesting because when people think of losses, they think, well, if you don't have losses, you're like a Ponzi scheme. Well, not if you're properly hedged and have insurance to really benefit from this. So I think this is a new framework for me because it's a way of actually thinking you could actually make more money with less risk, and the insurance doesn't have to cost that much. That's what I think is so impressive. So this changes everything really when you think about it. So many people are hawking the latest stock and things of that sort. Those are huge risks. So a lot of stocks, I mean, I've seen it with my friends. They buy a hot stock and it goes down 95%, like Virgin Galactic or some crap like that. So this is a new way of thinking about it. We can get insurance on our downside risk, and the only risk that exists is if a lot of people say, "Hey, we gotta start buying insurance." But I kind of doubt this because there will be a lot of different kinds of ways of buying this kind of insurance. And so I just think that it should not be a problem over the long run. But we do have to keep this in mind in these time periods where it's even harder than ever before to really understand what the market is doing. We need to be properly hedged, and then we can make a lot more money. And if you do make a lot of money, you definitely should subscribe and comment, leave a comment in the comments below. If you have already bought puts and you always have this put allocation, that'd also be quite interesting to hear. So let me know what you think, and hit subscribe and hit the like button. Thanks.